Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 26 in our series for 2024, and today's date is Friday, July the 26th. First, I'll be talking to Sonia Schwabsky, the CEO of the printing franchise Kwik Kopy. I first spoke to Sonia last year for Talking Business. This time we'll talk about the company's strategic vision and transformation in this digitally disrupted market. She'll talk about how Kwik Kopy delivered growth opportunities for franchisees and clients. And I'll talk to Indeed economist Callum Pickering about Australia's latest unemployment figures. But first, let's talk to Sonia Schwabsky. Well, Sonia, how long have you been at Kwik Kopy now for?
Well, I just hit my 2-year mark back in March. So I've done 2 financial years now. So coming up to the end of my second kind of financial year, but 2 years working.
And Kwik Kopy, it's basically a franchise, isn't it?
It's a franchise, yes. We are one of the oldest, or up there with one of the oldest franchises in Australia. We've been operating for 42 years. So one of the founding kind of franchise operations in Australia, I would say, with the Penfold family. Very heavily involved in the franchise industry and the setup and all of the things that come with the frameworks around franchising for 40 years.
So tell me, do you do mostly digital copy?
Well, Kwik Kopy started back in the day as more of a copy shop on every corner, but it's evolved so greatly, particularly in the last, I'd say, 10 years, with the quality and type of products you're able to do on these digital machines just becoming more and more the way that print is done in this day and age. So we do what's called digital print as opposed to the old school offset print that was around for many years. And we do that in local based businesses which sit in your local area. So we're really focused on B2B printing in local areas.
So who would your main customers be?
Our main customers, now we deal with everyone. So if I think about the different types of customers who look for us for print expertise, that would be anyone from a big corporate operation who's looking for someone to come in and just do part of their marketing communication mix, to SMEs, which probably our biggest customer segment is SMEs in Australia, which is 96% of all businesses in Australia qualify as SMEs. So they'd be our biggest customers, and we can do anything from, their business cards to pull up banners to their signage to promotional products, and some of the areas we're moving into is more around design and digital marketing.
Okay, so what are the big challenges?
I guess the challenges we've had, and we've had a lot of digital disruption in the last 10 years and a lot of new players into the market. So I'd say it was about 10 to 12 years ago you had the big online international printers come into the market. Of late, we've had all these design tools like Canva, PixArt, and a number of different online design tools, which have also disrupted the market. And then you've had other more like retail type operators getting into our space. And then you've had the big offset printers saying, well, hang on, our offset printing is dying. We're going to come into the digital print space. So we've had a lot of disruption, but what we've been able to do is to address that by saying, look, we provide personalized local service. So if you want to talk to someone and you want someone to help you, which you do need, it's a high involvement type product, you can come and see us, and we can do all of that for you.
As opposed to outfits like Canva.
Yeah, Canva's software at the end of the day. So you don't have anyone to talk to, you're doing it yourself. And a lot of what we find is a lot of people outgrow that. So if you're an SME and you start a business, I need to design a logo. Yes, I might go on to a logo design tool, but then you've got to really translate that out into all of your communication materials. And that's when it gets a bit more difficult and people lose interest in doing it themselves. They should be focused on growing their businesses perhaps not designing at that point.
Well, the issue too for a lot of SMEs is a lot of these tools that require some savvy with technology. And a lot
Yes.
of SMEs don't have that savvy, or they don't have the time to develop that savvy.
Mm.
And so they don't know quite how to get the most out of, say, an outfit like Canva.
Yes, I'd say that you're exactly right on that. There's two reasons. One, they don't have the time to go and kind of learn it, even though the tools are relatively easy for someone who's tech savvy. But you're right. If you're of an older demographic and you haven't grown up around them, then it might be more difficult. But what we find is when you're a small business owner, you're wearing so many different hats. To sit there and actually learn something that you're not going to use in the rest of your business takes time away from the real core business activities that you should be doing. So that's where we come into it, and we can get involved and take it from an initial idea and turn it into all of that marketing collateral that you need.
The problem you've got is that technology is constantly evolving. So you're constantly getting new players coming into your space. How are you going to deal with that?
Well, as a I guess we've found what we call our customer value proposition, and the piece that we bring to the table is that human centered service offer. So we become your reliable, trusted partner that you can call at any point and say, "Look, I need this done." We can give advice and also tap into what's going on. Now, a lot of the new players coming in, and you'll notice it, they're really going for less labor intensive type operations. We're already established in that area. To build a labor intensive service offer at this stage of the Australian economy is very difficult. So most of the new players coming in are really coming in with limited human resources in their business model.
Because they're very new. They themselves are startups.
Yes, they're startups, and they're coming in and using technology, which is fantastic. But a lot of this, the cost of labor and your business model, like I'll give an example. A lot of them are coming in and using, for instance, offshore customer service teams. Now, you can't tell me that those offshore customer service teams are going to have the same wherewithal to support your business. One, if they're not in the market here, they don't understand the industry, and they don't understand your local market that you're operating in. And then on top of that, they're not a business owner, so they don't have the same care factor. They're just an employee. So all of those factors really play to our strengths. We've got business owners in your local community that understand your market, understand what they're doing, and can have that ongoing relationship that gives them the knowledge about your business so that they can serve you even better.
As opposed to a virtual contractor.
Correct. Yeah.
Okay.
Yes. Well, correct. I mean, even some of our big online players, we know that their call centers are located in the Philippines or wherever they may be. And so you don't have that continuity of knowledge.
Mm,
When you've got a business owner, they're not chopping and changing. Even if I think about some of the operations in Australia, they're employees.
mm.
They're moving around a lot more. So they might be staying in one of these B2B operators. They might be 18 to 23. They might be there for a year.
Mm.
So that you're not forming any sort of long-term relationships with people that have a real interest in doing a good job.
And for an experienced business owner, it would be very difficult dealing with a virtual contractor who is, as you say, 18 to 23 years old.
Yes, well, even a local staff member. We know that, particularly if you think about marketing roles, I look at those a lot. The average tenure of a young person in a role is 12 months. The average tenure of a CMO is 2 years. So you just people are moving jobs a lot more in this day and age. What we find that even the staff and the business owners in our business, they're staying around a lot longer, their staff included. They've just got a lot more longevity of tenure. They're able to keep their staff members happy. It's a smaller business, more family oriented, and they really tap into the ethos of what it's like to work in a small business family operation.
So the customer value proposition for Kwik Kopy is basically we're here to stay and we're here to talk to you.
Yes, we're a trusted business advisor, and and we value our relationships and getting to understand your business so that we can serve you better. I mean, we have an NPS, which is a Net Promoter Score, which I guess it measures how good our service is. It's 97%. That's massive. Like, it's a really high Net Promoter Score. Like, you
That
don't
is
see that.
that's
Yeah.
huge.
Yeah. So
You find very few businesses would have that NPS.
exactly. Yeah, I mean, service. We just so our franchisees, like I said, because they're business owners, it's directly related to their livelihoods and their success. And so the care that they take and the service that we provide, they go above and beyond. Like, it's just some of the stories we hear, and so therefore the reviews and the NPS ratings we get are just based on what we do as a business.
Well, Sonia, that's all quite fascinating and important. And wishing you all the best.
Yes. Okay. Well, thanks, Leon. It was great to talk to you again.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, unemployment edged up to 4.1%, and it looks like a pretty full labour market. What's your view about this?
Yeah, it was an interesting market report because obviously the employment figures were very strong, up around 50,000 people in the month, which is a great result at this point in the economic cycle. But of course, the unemployment rate did also tick up a little bit to 4.1%, and it's up by half a percentage point over the past 12 months. So the trend there is pretty clear that the labour market is still very tight, but it is getting a little bit looser over time. And so what it indicates is that the job market is still very resilient, and yet there's clearly a bit of a slowdown there, which indicates that monetary policy is, having the intended effect at the moment.
And it's keeping up with population growth, isn't it?
Yeah, that's one of the reasons why we do have very strong employment gains on one hand, but also unemployment rate rising. And that's because population growth has been so strong. So the job market is right now sufficient to sort of absorb that stronger population growth. But one of the risks that we potentially have is if the job market really slows down, if the economy slows down even further, and that was no longer the case, then you'd end up with a pretty swift spike in the unemployment rate.
But the unemployment rate isn't rising because people are sacking staff. It's more that more people are coming in.
That's correct, yes. The rate of layoffs across the economy is actually really low. It's well below normal level. It's well below the average that we saw in the decade before the pandemic began. So that's obviously a good sign, because if the job market was really struggling and if businesses were really struggling, then we'd be seeing a heightened level of layoffs, and that simply hasn't been the case. The reason why the unemployment rate's increasing is because there's lots of people coming into the country and we're creating a lot of jobs, but we're not necessarily creating enough jobs. So employment increased by around 390,000 people over the past year. That, by any standard, is an outstanding result. It's one of the highest annual rates we've seen sort of outside of that immediate pandemic period. And yet the unemployment rate is still increased by 0.5 percentage points over that 12-month period. So that really highlights just how many people are coming into the country and sort of the impact that's having on the unemployment rate.
And most of these jobs were full time. Would that be right?
Yeah, the last couple of months, almost all of the jobs being created have been full time. So while employment was up around 50,000 people in June, about 43,000 was in full-time jobs. So that's a good sign. We like to see that. We like to see high quality, high paid jobs being created. But I think it's also important that we do take a little bit of a step back and we look at how things have been over the past 12 months. And it's actually been the reverse. That is, we haven't actually had that much full-time job creation over the past 12 months. It's really only been in the last couple of months that that's occurred. Over the past 12 months, full-time job creation's only accounted for around a third of all employment gains. So that is something to keep an eye on, although the fact that it has reversed somewhat in the past 2 months is obviously a positive.
And it indicates what's happening with the economy. Would that be right?
It can do so. Yeah. I mean, normally full-time job creation is a sign of a strong economy. Now, I wouldn't necessarily say that we have that right now. I mean, economic growth has been somewhat lackluster, and that might be one of the reasons why full-time job creation hasn't been that strong over the past 12 months. But maybe what we have seen in May and June with regards to full-time employment is a sign that maybe market dynamics are shifting a little bit. And that could actually be a bright spot or a good sign for the economy going forward.
What about underemployment?
It declined in June, down to 6.5% from 6.7% back in May. And that was likely driven by the strong full-time job creation. So that's another reason why we like to see full-time jobs being created because it ensures that people are getting the hours that they're looking for. So we're down to 6.5%. That's still pretty low. It's still, below pre-pandemic levels, which is a good sign. And so underemployment isn't a major problem for the Australian job market or the Australian economy at the moment.
The fascinating part is about how this will play out with the RBA, because the figures are pretty much 4% unemployment is pretty much in keeping with the RBA's projections.
Yeah, that's right. It's pretty much bang on what the RBA expects by mid-year. They think the unemployment rate will get to around 4.3% by the end of this year, 4.4% by the end of next year, but 4.1% is exactly what they were sort of expecting by mid-year. What I will say, though, is I think that the ongoing strength in the job market, the very strong job creation that we are seeing, will give the RBA some confidence that they can raise rates in August or September if they deem necessary. So if inflation is deemed sufficiently high and they're concerned enough about that, I think they can hike rates without being too concerned about the job market impact, given the strength we are seeing across the labour market at the moment.
It's interesting because there are all sorts of projections about what the RBA might do. There are some that are saying the RBA might keep rates on hold.
There's a lot of disagreement at the moment. I think most people think that this is potentially a live RBA meeting, and by that I simply mean that there could be a decision made, but there's certainly little agreement as to whether they will or not. I think it's probably a coin flip in my mind. I can certainly see the arguments in favour of hiking rates, particularly if the inflation figures at the end of this month come out on the nastier side. But the market is certainly been quite cautious. As of yesterday, the market was pricing in a 22% chance of a rate hike in August, which personally I think is a little bit too low, but that gives you a sense of whether the market is sitting at the moment. It's all going to come down to the inflation figures. We saw some really nasty figures in May. If the figures are just as nasty in June, then I think it becomes very difficult for the RBA to keep rates on hold. I think they're going to be forced into hiking rates if inflation is at that high level.
But the monthly figures are a bit more volatile than the quarterly figures.
That's certainly the case, yes. So the May figures were those monthly figures. They do tend to be a little bit volatile. They can move around a bit, and certainly the RBA will be hoping that those May figures were just a sign of volatility rather than something quite troubling, causing that inflation. But we'll find out at the end of the month, because we get both the monthly and the quarterly figures. The quarterly figures tend to be pretty stable. They're very reliable. They're very comprehensive. And the RBA will be getting those figures about a week before they have their next meeting. So we'll have a very good sense of whether the RBA is going to pull the trigger come the end of this month.
And one of the issues in Australia, of course, is the structural problems, because we have a housing shortage and, of course, rents are going up, and that's feeding into the CPI figures.
That's certainly a key part of it. Yes, rents are growing at a rapid pace. So are just service sector inflation in general. A lot of the inflation we are seeing is in essentials or non-discretionary items, which are very difficult for people to sort of reduce their expenditure of, rent being a key part of that. So it's going to be an important dynamic going forward, in large part because rents tend to be really sticky. They move very slowly. So any shift that we see in rental growth isn't going to happen overnight. It's going to take place over 6, 12, 18, 24 months. So it's going to keep putting upward pressure on inflation going forward.
And the issue with the inflation figures is they tend to be sticky. They're not going up massively, but they're still hanging around the same levels.
Yeah, there's different dynamics at play with regards to inflation. You have things such as goods inflation, which tends to be quite volatile. It can be impacted by exchange rates and global prices. And the prices of goods have, moderated quite a bit. They're sort of at quite sustainable levels. And then you have the service sector side of the economy, which does tend to be quite sticky, slow moving, difficult for the RBA to target and impact. And those prices are remaining, well above sustainable levels. The RBA needs to see a big shift on service sector inflation, and I think they probably need to see it quite quickly as well. So there is a bit of a concern that while service sector inflation has come down, it's not coming down anywhere near as fast as the RBA expected or the RBA wants. And if that continues to be the case, then that creates a compelling argument for further rate hikes to address that.
Certainly the figures out of the US aren't that heartening in terms of inflation, because their inflation tends to be quite sticky and stuck at the same point.
Yeah, there's a little bit of that. Obviously, they've seen much stronger easing of inflation, so they're at a very different point in their sort of economic cycle than we are. We haven't seen anywhere near as much easing of inflation. And one of the reasons for that might simply be that the Federal Reserve was more aggressive with regards to rate hikes than the RBA was. But certainly the RBA will be looking at what we are seeing in countries such as the US and across Europe and Canada, across the ditch in New Zealand, to get a sense of how prices are sort of impacting things globally, because that tends to also spill over to Australia to some degree. So the fact that we have seen inflation come down globally is a good sign for Australia. That will feed in, that is impacting goods inflation. But the fact that some of these economies are also sort of struggling to get their inflation down to target is also a little bit of a concern as well.
And the other issue is that the RBA was much slower to respond to the inflation figures with rate hikes and other central banks.
Yeah, that's been a criticism of the Reserve Bank. Now, there's some logic to their thinking because in Australia, a lot of people who have mortgages have variable rate mortgages. And so the flow through from interest rate hikes, at least with regards to households, tends to be a lot quicker in Australia versus other countries. But there's a variety of other sort of transmission mechanisms through which interest rates affect the economy. And the stronger action from the likes of the Federal Reserve have probably had a bigger impact through those mechanisms than has been the case in Australia. So households have been hit pretty hard, but perhaps other parts of the economy not so much due to interest rates not rising as much here versus elsewhere.
Well, the other problem too is that historically the RBA doesn't just move with one interest rate hike, but two.
That's true. Yeah, they rarely make a single rate hike. So if they do decide to hike rates come August, then there is an awfully good chance they might also do so in September. So we're not necessarily looking at a 25 basis point hike. We're looking at a 50 basis point hike over the course of two meetings or over 2 or 3 meetings, being the most likely scenario if those inflation figures at the end of this month come out pretty bad.
Well, Callum, it's been great talking to you, and thank you very much for your time.
And thank you.
So what's happening in the news? Well, what does the market anticipate in a potential Kamala Harris presidency? Investors should expect the potential Harris administration to defend the economic policies that Biden instituted during his term, including the Inflation Reduction Act subsidies for electric cars and green energy projects, increased IRS funding to pursue wealthy tax evaders, excise taxes on stock buybacks, and a 15% corporate minimum tax for large corporations. A Harris presidency would be, for all intents and purposes, a continuation of the Biden administration. Isaac Boltanski, Director of Policy Research at BTIG, told MarketWatch. Even in the event of a Harris victory over Donald Trump in November, analysts say that it's likely Republicans will take back the Senate, limiting Harris's ability to sign partisan legislation. She would immediately be faced with the need to negotiate over the extension of the 2017 tax cuts, which temporarily lowered individual income tax rates and increased the child tax credit. Biden has promised to extend those cuts for families making less than $400,000 per year, and analysts say Harris will likely adopt the same position. A scenario where there's a Democrat in the White House, while Republicans control at least one chamber, will be one in which investors should expect a bit more fiscal restraint than if Trump wins or there's a Democratic sweep, according to Henrietta Trays, Director of Economic Policy at Vita Partners. Harris doesn't have a long track record on economic policy, as most of her public life has been spent as a prosecutor, but a brief time as a senator and 2020 presidential candidate could provide some insight into her views. During her stint as California Attorney General, she helped secure a $25 billion settlement for homeowners who had been wrongfully foreclosed upon in the aftermath of the financial crisis after bowing out of national talks that netted residents of other states less money. She also championed Homeowners' Bill of Rights legislation in California, two moves that cemented her status as a consumer advocate in the lead-up to her 2020 run. Harris focused on the struggles of low-income and middle-class home renters as well, proposing during a presidential run a tax credit for families that spend more than 30% of their income on rent and utilities that would come in the form of a monthly check. Another important factor in Harris's biography is her long ties to big tech firms. As a San Francisco-based politician, she has cultivated close connections to large technology firms like Meta and Google parent Alphabet, a fact that was seen as a liability in the 2020 Democratic primary, but which could be good news for tech investors if she wins the presidency. However, if Trump continues to pull ahead in the polls and investors view his win as inevitable, then the Trump trade will take over. The dollar is generally expected to get a boost if another Trump presidency looks more likely. Trump's preferred mix of low taxes and high tariffs are seen as spurring inflation and interest rates, adding to the dollar's appeal. The currency also experiences higher demand in periods of uncertainty, thanks to its haven status. The conclusion that Trump spells inflation has also seeped into the world's biggest bond market, with traders embracing a wager that involves buying shorter-term maturity notes and selling longer-term ones. As Harris's odds have risen, so have the Democratic odds of winning the House, said Stephen Englander, a strategist at Standard Chartered Bank in New York. If this is how it plays out, then fears of further fiscal stimulus may wane and take some pressure off rates and the US dollar. But it is still very early days on what may be a very different campaign than expected even 2 weeks ago. And rapidly rising building costs are keeping inflation in Australia higher than overseas, Reserve Bank of Australia Governor Michele Bullock has warned, as the economy enters a difficult stage where demand remains too hot. We're not seeing the same progress on inflation as overseas, she told an annual superannuation lending roundtable. But having said that, we know from overseas that progress is bumpy. It's up and down. So the challenge is understanding where the risks might lie. Persistent inflation has left the RBA as the only major advanced economy other than Japan, where markets price the possibility of another rate rise. Investors ascribe a 1 in 4 chance of a rate rise when the RBA meets on August 6. Ms Bullock said the RBA board was balancing the fact that demand was still too strong with the fact that monetary policy acts with a lag. Parts of the economy, like the jobs market and household spending, were slowing in response to action already taken by the RBA board. Economists say the outcome of the June quarter Consumer Price Index to be released on July 31st will be vital for determining whether the RBA is forced to raise the cash rate from 4.35% to 4.6% when it next meets. While the RBA expects underlying inflation to fall from 4.2% in March to 3.8% in June, a string of stronger than expected monthly figures has raised the possibility that underlying inflation could come in closer to 4%. And the CrowdStrike outage hit about 8.5 million Windows-based computers and laptops, costing the global economy billions of dollars. Australian businesses this week scrambled to restore services amid questions over costly compensation. Financial impact on Australian businesses from CrowdStrike's IT outage could surpass $1 billion and last for weeks, according to business leaders. The outage, caused by a faulty software update, grounded planes, closed supermarkets and caused widespread chaos for thousands of organisations and millions of people late last week. Home Affairs Minister Claire O'Neill said teething issues stemming from the outage could last 1 to 2 weeks. But Australia Industry Group CEO Innes Willox said he expected the damage bill from the glitch to run into the billions of dollars. It's impacted different businesses and different sectors of the economy in wildly different ways, and the reality is we're going to be seeing the tailpipe of this for weeks to come, he said. Mr Willox said it was still unclear whether affected businesses would be able to seek compensation from CrowdStrike for any losses incurred from the outages, whether there might be some federal government scheme in place to help businesses seek redress, or if businesses are going to have to deal directly with the CrowdStrike to try to work through compensation through their insurance, is still unclear, he said. Wedbush Securities technology analyst Dan Ives said CrowdStrike had already suffered a huge hit to its brand, which was built on providing cybersecurity. There's brand damage here, he said. This is something that's going to be going for months, potentially years. CrowdStrike now becomes a household name, but not in a good way. Mr Ives expects the company will be dealing with a large volume of legal action in the coming months. And Australian winemakers are now finding it harder to sell wine to China with its economy under strain. Cost of living pressures are plaguing households and made worse by a political shift to modesty and frugality being led by Communist Party officials and taken up by large swathes of the population. This has shown up in recent import data for wine, with China importing only 1.6 billion of wine last year, down more than 60% from a peak of 4.28 billion in 2018, of which a large proportion came from Australian winemakers. Taylor's Wines, a major company, is adopting a cautious approach to re-entering the once thriving Chinese export market, balancing the riches from once again striking it big in the country with the more sobering fact that the Chinese market is not as big as it once was. The winemaker, for example, is now looking beyond China to newer nearby markets such as Taiwan and South Korea, where its top-end luxury brand, The Legacy, which sells for $1,000 a bottle, had allocated 2/3 of its available supply to China, there was now just 1/3, with the rest spread across other Asian markets and duty-free stores. It's this sense of excitement, mixed with the cold hard slap of reality, that is facing many Australian winemakers, as the lifting of the 200% plus tariffs in March brings back what was once a billion-dollar export market, but is just in the last few years much different, harder to sell and vastly smaller. And Australia's housing supply and affordability crisis is likely to deepen and will remain a chronic issue, according to Oxford Economics, which is predicting the nation will fall well short of the federal government's ambitious plan to build 1.2 million homes over the next 5 years. A new report, Building in Australia, released on Monday, forecasts just 960,000 new homes will be built between now and 2029, well short of the 1.2 million target in the government's National Housing Accord. The figures underline industry fears that it will struggle to keep up with the predicted population surge, fuelled by a wave of new arrivals, as labour shortages, dysfunctional planning system and high costs crimp activity across the sector. Report author Timothy Herbert, Oxford Economics Head of Property and Building, said while new housing construction would reach record levels by the end of the decade, it wouldn't be enough to keep up with the surge in demand. The report estimates new home starts in the 12 months to June 2024 fell 10% to 155,700. A small 2% rise to 158,300 is predicted in 2024-25 before activity ramps up to 241,900 new homes in 2028-29, marginally above the record set in 2016. It forecasts the current 146,000 dwelling stock deficiency will increase to 164,000 by June 2027 as builders struggle to keep up with rising demand. The government's big build officially commenced this month, but industry fears are mounting that it is already slipping behind its 5-year target agreed with state governments in August. The Housing Industry Association this month warned the government would fall short of its housing targets by 64,000 properties in the first year alone. To reach the 1.2 million target by the end of June 2029, an average of 240,000 homes need to be built each year. However, only 960,064 total new homes were completed over the past 5 years, despite the pandemic home builder stimulus, which sent building levels to record highs. And Sky News Australia could be forced to change its name once its licence for the brand expires, amid a widening gap between its content and that of its namesake in the United Kingdom. The News Corp-owned Conservative network, which counts Peter Credlin, Andrew Bolt and Chris Kenny among its lineup, has told staff it is beginning a major piece of work as it plans to move into a new studio. Sky News Australia Chief Executive Paul Whittaker told staff last week that the broadcaster would move from Macquarie Park in northwest Sydney and into News Corp's headquarters in Surrey Hills next year. Sky News Australia began as a joint venture between British broadcaster B-Sky B, Seven West Media and Nine Entertainment. In late 2016, News Corp acquired Australian News Channel. At the time, it owned 39% of Sky plc, the rebadge B-Sky B. In 2018, however, Rupert Murdoch sold his Sky stake to cable giant Comcast for $22.5 billion. The sale meant Sky News Australia no longer had direct ties to its UK counterpart, except a name, which sources close to News Corp said was a 10-year licensing deal. That arrangement was due to expire sometime in late 2025 or 2026. Names being flagged as possible alternatives by those close to News Corp include Fox News Australia, Talk Australia or Australian News Channel. Licensing the Fox name would likely mean a deal to pay Fox Corporation, whose executive chairman is Lachlan Murdoch. Lachlan Murdoch also chairs News Corp. Talk, formerly Talk TV, is the name News Corp UK gave its own opinion-oriented streaming service launched in April 2022. Sky UK is less conservative and opinion-led than Sky News Australia, and there are early signs Sky will not renew its licence deal with News Corp. And Peter Dutton has conceded nuclear power policy will come with a huge initial cost, but says that will be offset by the 80-year lifespan of each facility. Speaking from Queensland near Callide, where he intends to build one of 7 reactors, the opposition leader said he would soon be presenting a business case for his plans, rather than just costing. It is a really important point that nuclear provides cheaper electricity, he said. There is a big upfront capital cost, but you can amortise that cost over 80 years. It makes it a cheaper source of energy. Mr Dutton visited Collide as the latest poll showed solar energy and gas remained the most popular forms of energy, followed by onshore and offshore wind. Nuclear was sixth in the pecking order, just above coal. Net support, as measured by the difference between those who support and oppose each energy source, was 70% for solar, followed by 46% for gas, and 17% and 16% respectively for onshore and offshore wind. Despite the wake-up call over green hydrogen that was delivered by last week's retreat by hydrogen advocate Andrew Twiggy Forrest, net support for hydrogen lifted 3 percentage points from last week to 39%. Support for nuclear energy was 37%, but opposition was 35%, giving it a net support of just 2%. Coal, 35% for and 34% against, had a net support of 1%. Mr Dutton was not allowed access to the Collide coal-fired power station for his press conference or community consultation. For this he blamed Queensland Premier Stephen Miles. The federal opposition has announced plans to build 7 reactors in 5 states, with the first to be operational by 2035 or 2037. There will be 5 large-scale power plants and 2 smaller modular reactors. Based on the scant details so far available, the CSIRO has estimated a total build cost of about $60 billion in today's dollars for these facilities. Other estimates, based on actual build costs abroad, are much higher. Mr Dutton argued the life of a nuclear power plant would be 3 times that of a large-scale wind farm. And insolvencies in the building construction sector are already level with pre-COVID-19 calendar year totals, and numbers are set to exceed historical highs. Alare's director, Patrick Schweitzer, said the building construction industry had been particularly hard hit this year. The full projection year for 2024 is expected to well exceed historical highs. There's clearly a catch-up taking place from the COVID years, Mr Schweitzer said. The latest Alare's Credit Insights report found insolvencies among licensed building companies to the 6 months to June 30 were on par with the full year totals of about 400 in 2018 and also 2019. Mr Schweitzer said that according to ASIC Sources figures from 2020 to 2022, there were 8,000 fewer insolvencies across the board over the 3 years when compared to pre-COVID figures. This suggests the current increase in insolvencies will continue through the remainder of 2024 and potentially into next year, he said. The building company figures leave out unlicensed businesses, which make up most of the building and construction sector. And that's it for this week. And next week, I'll be talking to Fred Tearley, the Chief Information Security Officer at Interactive. We'll discuss how businesses can mitigate risks associated with AI. And I'll talk to Rabobank economist Michael Every about why the Chinese Communist Party third plenum told us nothing about China's economy and how it can be fixed. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn, and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles, or advertorial, email me. Wishing you all a safe and healthy week, and looking forward to bringing you Talking Business next week.